Now, this was really interesting to me is when you look again nationally over the past handful of recessions, prices do not have to fall. And this graph is showing you that there are some recessions that prices went down double digits. There are some recessions where prices went down single digits. And there are two recessions in the 70s and in the 80s where prices actually grew during a recession. So you do see that it doesn't have to be, and it's what caused the recession, how many people still have jobs, what did we see in terms of the relationship between, to your point, income and home payment? Is there still some room to be able to keep the prices going up? So it's interesting because I always assume prices just
Yeah, so
collapse
maybe the
every cycle.
soundbite for this slide about it says home prices can grow or fall during recessions. The soundbite is the economy is not the housing market, and the stock market is not the economy, and the stock market is not the housing market. These are three different things, right?
Yep.
Yeah. Okay.
Yes, exactly. But on a local level, you can see here, this is your mix of Vegas. This is now going back to the same chart I showed for sales, but this is for price, where the top line is your best case for these select markets. So in a lot of these markets, your best case is flat prices. This is looking at Vegas, Phoenix, Atlanta, Orange County, DC, Seattle. And then again, you look at how the Great Recession just skews the data, makes the average look so much worse. In Vegas, prices down 65% during the last cycle.
Okay. So your
So
chart
very
here,
interesting.
the range widened thanks to the Great Recession. So 20% decline in Las Vegas, right? No, 60% decline. Oh,
That's
that's
the
that's
average. Yeah,
the average. Okay,
65%.
um, and
Yep.
Phoenix about 60%. Okay, so what else do
Mhm.
you? I don't know if I totally got the takeaway on this slide. What's the complete takeaway here? Just wrap that up for us.
So the takeaway is that prices, it's basically the same takeaway as what you see here, is that in some of these markets, the best case is that you're not going to actually see prices collapse. And the average number that you're seeing in those blue bars is in Atlanta, you have to make sure that if you bought a property or you're working in a community, if prices go down 13%, can you still be successful? Does it still make sense as an investment? So it basically shows you this is your scenario testing. Are we going to be okay if we see prices correct by 13%? Are we going to be okay if prices go down
So,
5%?
speak to most of your clients, developers, real estate developers. That's who buys your research mostly, right? So, in the Atlanta example, with a 13% correction, I mean, basically, the builder's profit is off the table, isn't it?
It would be very difficult if they
Right.
didn't plan
So,
for that. Yes. So it needs to be, they can do, they can work around with, if we're talking about a builder, they can work with a developer on maybe takedowns, so they can look at different phases. They can figure out, not that it's easy to cut costs, but they can figure out what can they do to try to adjust for that. But yes, I mean, that's not going to, the margins are already squeezed. So this is going to,
and the interesting thing I've noticed about developers in building these home communities, as they move into recessions, it may not actually make economic sense for them to keep building, but they kind of have to many times because they've already secured the money, they've secured the land, they've secured the entitlements. They got to just build it, right
yes.
into the bad market. And to some extent, it's just to keep the corporate machine going. So the interesting kind of departure here is there's the company, the real estate development company, which is a business, and then there's each individual real estate deal that they sell. And these both act differently, don't they? They have different business cycles.
They do. And it's interesting that you say that they have to keep building because in some markets, like I was in Salt Lake City recently, and Lennar is a big publicly traded builder, and they came in and bought Candlelight Homes, which was a local builder. And Salt Lake City is we want to know who the builders are. We want them to have, we want to see their name. There's brand recognition in Salt Lake City more than you would think, and they weren't able to rebrand as Lennar. So to your point, they need to keep having their name in some of these markets that they want to see, okay, Candlelight Homes is still selling homes. They're still here. They're still active. And that helps them coming out the other side
That's
of
a
the
good
cycle
point.
as
So
well.
when you're thinking long term, as every corporation and person
Mhm.
should,
Yeah.
you still want to keep your brand out
Yes.
there. For example, if you're a franchisor,
Yes.
you never want your franchisees closing up. It looks bad.
All right. So that is just to go into how is today different? What are we seeing in the data? If that's the best worst case from history, and we can do our best to learn from history, but how is today different than what we've seen in the past? And one of the biggest ones, and this chart to me is just so mind boggling. What this is showing is there's two different lines. There's a blue line and a gray line. And the blue line is showing the cumulative number of single family housing starts that they actually started construction during the expansion of the 1990s, which is now the second longest expansion of recent history. The gray, which is about half the size of the 1990s, is the current. So how much cumulative single family housing starts have we built in this cycle? And you can see it's half the levels of the 1990s. We're 2.5 million units shy of actually matching long-term demand. If you try to match up population growth with these numbers too, we are so falling behind in terms of bringing more supply to the market. But the problem is, I don't think we'll ever get back to the 1990s level. You had, unless we start going to secondary and third tier markets, because you don't have the low hanging fruit. You don't have these huge master plans. You don't have all this land that you can all of a sudden bring to mass scale a lot of homes like you could.
That is really fascinating. So for real estate investors, this is great news, right?
Yes. Yes.
There is a
Yes.
very real housing shortage, and it's going to continue for, well, who knows, right? Because, like when they built the Irvine Ranch, where you're sitting right now, that was a
Yes.
giant master plan community, and it's true. You don't see nationally that many of these big master plan communities. I just visited one in the Tampa, Florida area last weekend because I wanted to see the Crystal Lagoon thing, and that's sort of this hot new development trend, but that kind of land, it's just not there anymore. So you've got to do assemblages and infills and things like that, and that's a lot more cumbersome, right?
In that we're seeing in the data, I don't think I have it in this deck, but we're seeing the shifts to the Tampas of the world and the Jacksonvilles of the world and all of these. Maybe they weren't tier one cities. They still had a lot going for them, but they weren't LA and New York and Seattle. And we're seeing a lot of the development occur there. And Tampa's honestly my favorite market in the country. Like, I would put money on Tampa becoming one of the next markets that we move to, because there still is developable land. You still have to go maybe a little north of the city, but it has the beaches, it has lifestyle, it has relatively good weather, and it has that appeal of, if you're from the Midwest or Northeast, you can still get a lot of lifestyle, but you can also live in a slightly better climate.
California, so do I.
Tampa.
California's got to be become more business friendly. It just and more developer friendly.
But I don't know where the development would come in California either. There's infill projects, but infill's still never going to get back to the scale of when you are building your
but
ranch.
when you get out of the major cities in California, up and down that coastline, there's really quite a bit of land. I mean, it's not. In the central California, there's a lot of land available. In north of San Francisco, Sacramento, there's lots of land available. So, there's really quite a bit more land than most of us kind of casually think of. But yeah, it's not in the cities that we're all accustomed to thinking about.
Because that's the question. This is like a long-term philosophical debate. But if there is a lot of land north of San Francisco, and we don't assume that people are going to commute to San Francisco or San Jose from that land, do we get more edge cities that develop around where there are pockets of land that's close enough to a hub, but they need to kind of create their own, almost like Orange County, create their own ecosystem that they can live off of as well? I think we'll see. All right. This is also showing, I think we talked about this yesterday, but this is just showing, I picked LA. It's not This is not unique to LA Orange County. It's just months of supply by price point. And there's been a lot of talk about how we are seeing more supply in the market and maybe it's shifting more towards a buyer's market than a seller's market. And I think the question really needs to be, what price point are you supplying? Because if you're under 1.5 million in California, it's probably not a buyer's market at 2 months of supply of inventory. But I think what this creates an opportunity for is when you look at different price points. I could show Charlotte, Salt Lake City, Denver. It would show the same trend. That tight inventory at the lower price point isn't necessarily desirable. Some of it may just be old supply that needs to be renovated. And I know there's a lot of jokes about how millennials like to watch YouTube and do a DIY of their house, but that doesn't answer for a lot of people that still just want to move in turnkey home that's not necessarily on the market, but could be.